Hello and welcome to this video about behavioral finance. What is behavioral finance? Behavioral finance is a subfield of finance, or to be more specific, traditional finance. Behavioral finance that aims to convey how psychological biases and emotions affect the decision-making processes of participants in the financial markets. Traditional finance assumes that investors are rational and always act in their best interest. However, behavioral finance takes into account that human beings are not fully rational, and therefore, the decision-making process is influenced by a range of cognitive and emotional factors. We can claim it is flawed to a certain extent. Behavioral finance incorporates findings from psychology, sociology, as well as other social sciences to create a more realistic understanding of how people act when making financial decisions. Understanding the cognitive biases and heuristics, which are simplified decision-making rules to overcome complex decisions, is a key challenge for actors in the financial markets. Hence, the discipline of behavioral finance as such helps individuals make better decisions in the financial markets. Behavioral finance and behavioral economics, which is a subfield of economics, are closely related fields that both study the impact of cognitive biases and emotional factors on decision-making processes. However, there are some important differences between the two fields. Behavioral economics is a broader field that examines how cognitive biases and emotional factors affect decision-making in a wide range of contexts, including social, economic, and political decision-making. Behavioral finance, on the other hand, is a more focused field that applies the insights of behavioral economics to the financial markets. When touching the topic of behavioral finance, it is important to emphasize the role of cognitive biases as an overarching concept. Generally speaking, in the course of decision-making under uncertainty, cognitive biases are prevalent to some extent. Cognitive biases are systematic errors in thinking or judgment that occur when individuals process information in a way that deviates from rational or objective reasoning. These biases can affect how people perceive, interpret, overlook, and remember information, and they are prone to lead to poor, irrational, or suboptimal decision-making. Cognitive biases can arise from a variety of factors, including the aforementioned heuristics, emotional or motivational factors, social influences, and individual differences in personality or experience. Becoming aware of common cognitive biases and working to mitigate their effects help individuals to make more informed and objective decisions. In line with what was just stated, we abandon the characteristics of the rational, fully informed Homo economicus. But how does that materialize into a theoretical framework? The theoretical milestone and foundation of many concepts in the field of behavioral economics, and hence, behavioral finance, was the prospect theory. It was developed by the psychologists Daniel Kahneman and Amos Tversky in 1979. It claims that individuals evaluate potential losses and gains differently. Let's look at a couple of examples. Individuals are risk-seeking when it comes to potential gains. For example, if an investor buys a penny stock that cannot lose much of its remaining value, we can observe risk-seeking behavior. This is captured here on the simplified graphical representation of the prospect theory. The y-axis depicts the personal value, whereas the x-axis captures the gains and losses. Individuals are risk-averse when it comes to potential losses. For example, in times of economic uncertainty and higher market volatility, investors prefer government bonds over stocks. However, in the case of strengthening market environment, investors might miss out on the equity premium when being invested to long in bonds, as stocks perform well in the subsequent economic upswing. As you can see, the curve is steeper third or left lower quadrant. Individuals evaluate outcomes relative to a reference point. People tend to evaluate potential gains and losses relative to a reference point, such as their current wealth or an expected outcome. For example, an investor who had accumulated a lot of wealth in the past is less risk-seeking, since the main aim is to keep the wealth. On the other hand, an investor who plays with little money and hence has a different reference point is more risk-seeking when it comes to the investment decision. In line with what was just stated, and to reiterate, individuals experience diminishing marginal utility. People experience diminishing marginal utility as their wealth or gains increase, meaning that each additional unit of gain is valued less than the previous unit. An investor with a portfolio worth $100,000 values an increase of $10,000 less than an investor whose portfolio had been worth $5,000 initially, which would be a staggering 200% gain actually. Therefore, the latter might feel wealthier than the former, even though in nominal absolute terms this does not hold true, since both individuals are richer by the same amount. This is represented by the flattening of the curve in the first or upper right quadrant. How do the concept of cognitive bias and the underlying theories, like the prospect theory, reflect reality? Uninformed or poor decision-making in the financial markets is strongly supported by narratives. Narratives evolve if poor judgment of market participants is accumulated. One might also say, Narratives are a powerful force in the financial markets, shaping investors' perceptions and influencing market trends. Here are some common narratives. This time is different. This narrative suggests that current market trends are fundamentally different from past trends and that traditional investing rules do not apply. In times of market euphoria, market participants deny the past and might take excessive risks. The market is rigged. This narrative reflects that the financial markets are controlled by a small group of powerful insiders who manipulate prices to support their own interests. The economy is in trouble. This narrative assumes that economic conditions are deteriorating and that the financial markets are on the verge of a meltdown. During periods of economic uncertainty, this can lead to panic selling. The next big thing. This narrative suggests that a new technology or trend will revolutionize the financial markets and create huge investment opportunities. This narrative often emerges during periods of innovation and can lead to speculative investing. Closely related to that, if the whole market is in the state of strong optimism, which is not supported by the underlying economic fundamentals, we talk about irrational exuberance. A term coined by former U.S. Federal Reserve Chairman Alan Greenspan. By understanding narratives and their potential impact, investors can make better informed decisions and navigate the financial markets more efficiently. Since we are now familiar with the distinction among the scientific areas and their terminology, what cognitive biases are, as well as a couple of common narratives in the financial markets, we would like to recommend the follow-up video Behavioral Finance, Practical Examples and Outlook, where we elaborate in more detail specific practical examples in the field of behavioral finance. See you there and keep in touch. Thank you for watching.